This is our Forex blog for March 23rd, 2011. And what we do most days is find a strong currency and buy it against one of the weakest currencies. After currencies make a 2, 3, 4, 5, 6, sometimes 7-day move in a row, they typically pull back. And that's what you had today, is a pullback day. The pound, which was previously very strong, you can see the daily, weekly, and monthly trend is up starting the day out. Yesterday was extremely strong. Today had a pullback day. And that's why you want to always look at the daily charts to get a feel for, how many days up or down a particular currency is. For example, the pound dollar, you can see on the daily chart here, was up 1, 2, 3, 4 days in a row. It slightly broke the previous swing high and pulled back a little bit from the high. So today, obviously, it could have went up or down. However, after being up 4 days in a row, one of our systems is a counter trend method. So when you start to see some weakness in the pound at 4, you want to see what's going on in the dollar. The dollar really wasn't strong at that point, but around 7 became strong. So after 7, it makes sense to look for pullbacks in the pound dollar. And in fact, even before 7 o'clock, you can see the pound pullback was underneath the hourly, tried to go up, double topped right here. There was no statistical momentum to the upside. And when it finally broke down underneath this low, this would have been a decent place to get in. You might have made a few pips on that, or you might have even been stopped out. It went back up again, and you can see tried to get over the hourly moving average, tried to go over the monthly R1. There was even less momentum to the upside than down. Aggressive traders would have went short here, hoping that the previous swing low right here got broken, and it did. And this trend just continued. It went and found support at the previous day's low, went sideways for half an hour or almost an hour, broke down from there. Another good place to go short, and you want to draw your fib on that first swing to get an idea of where to get out of that trade at. And if you're an aggressive counter trend trader, if the weekly and monthly trend's up, it usually makes sense to look for buys when the currency's way underneath the lower band. I actually scaled into a trade and was long around 62.27 here, and actually made a little bit of money on that trade and this trade. When the currencies are, in my experience, 30 to 50 pips underneath the lower white band, and you see any kind of weakness lessening like this, it's a pretty high probability trade for a snapback. It doesn't mean that the previous weekly monthly trends are going to continue. Remember, this thing's been up 4 days in a row. It's been up close to 400 pips, and so it might come up 150 or 100 pips today, then go down for another day or two because it was up too much on the daily chart. One of the currencies that was extremely weak at 9 was the Swiss. And the Swiss was one of those currencies where the daily, weekly, and monthly trend was up. It also has had many days up in a row, and down in a row, dollar Swiss. So looking for buys on the dollar Swiss off the lows when you see extreme strength in the dollar and weakness in the Swiss. Again, you're fighting the longer term trend, so don't expect to find any more than 20 to 30 pip moves. If you happen to get in one on occasion, then that's good. But this one came down, and you can see it was extremely weak earlier, and that trend continued a little bit at 20-30 pips. Came back up, and we have kind of a head and shoulders pattern right here. Once it made a higher high, because this one also was down a couple days in a row, it's very likely to reverse. You might have bought this pullback right here, or when it broke back into the previous day's range, and proved that it's making a series of higher highs, as you can see on here. When it broke out over this swing high and above the hourly, it was very likely to go to the next resistance area where there's likely to be some selling, and that's up here at 57. So if you bought this trade right here around 25, you have a potential of 30 plus pips while risking 5 to 10. And that's really the main secret to trading. Small risk and higher probability profit targets. Now earlier today, because the trend was down and you had incredible strength in the Swiss right here after a 2 or 3 hour pullback, the dollar had mild weakness and the longer term trend was down. You certainly earlier today could have sold the Swiss. This one kind of opened up with a very narrow range, and usually narrow ranges, once they're broken, tend to lead to 20 to 30 pip trends. And you can see the volatility even got less as time went on, making slightly lower highs right here. And you might have, just for safety's sake, waited for this swing low right here to get broken. You're short. You don't know if it's going to break this swing low. You don't know if it's going to stop here at the previous day's low. But if it does, you exit with a small profit. In this case, the next profit target's all the way down here at 90. And you're short somewhere around 25 for a 25 pip profit while risking 5 to 10. Anytime you see a sideways narrow range like this in a breakout in the direction of the longer term trend, it's a pretty high probability trade. The euro is also weak today, and yesterday had a pullback day. So, when it had a weakness here at 7 and strengthened the dollar, you have really high probability euro dollar sell. You can see coming into 7, one trader that I know took this fib target sell. Counter trend sell signals right at a fib target. Yesterday was a reversal day. This one, I believe, was maybe a 50% retracement back up to the highs from the high to the low. Let's make that a little thicker so you can see. You can see actually it was a 62% retracement back up from yesterday's drop, and it was also a fib target off of this wave. And this is what's called an this is what's called a Fibonacci cluster zone. Anytime you have multiple resistances, in this case Fibonacci, it made a higher high with slightly less momentum than the first wave up. It's a pretty high probability trade. The euro dollar was also up 4 days in a row and had a pullback day yesterday, so it was likely to continue down today, continue the pullback. That was a very high probability trade, and you don't know when you're short up there if it's going to stall at all this support, but once it breaks that, the next support level's all the way down here. In some cases, you might take a trade where your potential profit target's 15 or 20 pips. You believe it's a 60 or 70% odds trade to work, but if that support area gets broken, then the next profit target's so far down, 50 extra pips, it's definitely a high probability trade to take that. If you thought this was even 50-50, you're going to risk 5 or 10 pips maybe to make 20, but if that support got broken in this case, this is your next area. Now, a lot of our traders are using our new FX Momentum tool, and this is a phenomenal tool for helping you stay with these explosive trades. It has to load. So let's say you got short up here. Notice, it went up with some decent momentum, and then right here, you can see even though this bar was closing up, you had a counter trend sell signal, other euro pairs are going down. So once this kind of broke down from this 10 pip range up here, you might have shorted at 42.01, and notice as this starts coming down, all the euro pairs are going down a little bit, not violently, and dollar pairs are getting stronger. But as of right here at this bar right here, anytime you see a spike in this, that trend's very likely to continue, and it just kind of meandered its way down. You might have got out of half your trade right here when it kind of ran out of steam, and then when it hit the lower band, you can see the weakness is less. So you might have exited the second half of your trade at 41.30. Anytime you have an explosive trend, this is called our trend explosion system of plus 20 or minus 20, in this case minus 20, those trends are likely to continue. So after a little bit of a pullback right here, you might have also gone short right here. It's not as high a probability as trade is getting into it near the highs of the day, because obviously it has more potential room to fall. But here's your support area. It's about 20 pips away. You're risking 10, and you can see as it went sideways right here, on this bar right here, a lot of power in the euro, weakness in the dollar, and then it all but disappeared and then went sideways. So when you see extreme momentum to the downside and it goes up with very little momentum, it's a very high probability trade. This is probably 60% likely in my opinion to give you 20 pips while risking 10. And if you take those trades repeatedly, you kind of saw the same trade here. It went down, came back up. There's a little bit more momentum than before, but not that much. If you went short right here, you don't know if the trend's going to continue. But again, you're risking, maybe 10 pips to make 10 pips. It's not the best trade in the world. But if you get short and you start seeing some spikes like this, which we didn't have the first time down, then it's very likely to continue down. And we're coming up to the 4100 area. Even that riskier trade right here in the past, if you took it, you don't know whether to get out with a 5 or 10 pip profit or take a 10 pip loss. Now with these tools, you can see bar by bar whether to hang on, and your odds of the trade working or not working become revealed as each 3-minute, 2-minute, 5-minute, or even 1-minute bar finishes. In this case, we're using 5-minute bars so we can see more of the past history for class purposes.